The first week of October marked 2 years since the bull market, and stocks have climbed around 60% since 2022. While some see a silver lining in the stock market, Jim Rickards, the man who predicted the Great Recession and Trump's 2016 victory, has some concerns about what's coming next for the stock market. This video will look into Rickards' analysis, providing clarity for investors navigating these uncertain waters. So, what's Jim Rickards' prediction? Could the dollar actually collapse and the stock market fall by 50%? Well, the stock market usually sees some decent gains during election years. Looking back to 1952, the S&P 500 averaged about a 7% increase during those times. Naturally, the stock market and election results aren't directly linked, but there might be reasons for this trend. Leadership changes can create market uncertainty, which isn't good for stocks. The election season is proving to be quite the roller coaster ride for investors, with some unexpected events shaking things up. On July 13th, Trump faced an assassination attempt in Butler, Pennsylvania. Then, on September 15th, another alarming incident occurred, an apparent assassination attempt at Trump's golf course in Florida. It's not every day that a sitting president decides against running for office while two severe attempts on a prominent candidate's life shake the political scene. Yet, if we look back at 1968, we can see a similar scenario. That year, President Lyndon Johnson chose not to run for a second term due to declining public support, and astonishingly, Robert F. Kennedy, who was expected to be the Democratic candidate, was assassinated just months later. Well, surprisingly, by the close of 1968, the S&P 500 had recorded an impressive 7.7% gain for the year, translating to an overall return of 11%, slightly better than the average performance. Looking closer, it could be argued that today's economic conditions are more robust than they were back in 1968. While the real U.S. GDP registered a growth of 4.8% during that time, inflation was on an upward trend. To conduct a more thorough examination, U.S. bank investment experts closely examined market trends over the past 75 years. They analyzed average returns over 3-month periods following various election outcomes, comparing them to historical averages from their study. Using a method known as the t-test, they assessed whether the political makeup of the White House and Congress had any tangible effect on the average 3-month returns of the S&P 500. The investigation also took into account the specific moments when parties gained control of governmental branches rather than focusing solely on election dates. The findings were consistent across both approaches. Their research reveals that election results have a limited effect on financial market performance in the medium to long term. It appears that market returns are influenced more by overall economic trends than by who wins or loses an election. Interestingly, these results change the widely held belief that a sweeping victory by either the Republican or Democratic Party could lead to market turmoil. Historically, there has been no noteworthy connection between the control of both Congress and the presidency by a single party and market performance. Additionally, inflation is predicted to decrease, leading to lower actual interest rates, which generally isn't good news for the currency. When people feel anxious due to unrest and instability, it often decreases their willingness to invest, causing stock prices to drop and creating market fluctuations. Worries about political stability and the broader economic environment may make investors more cautious, resulting in a decline in overall market confidence and further affecting stock values. Billionaires are currently cashing out. Jeff Bezos just sold $8.5 billion worth of Amazon shares. The trust for the Walton family, the heirs of Walmart's founder, sold off $1.5 billion in Walmart stock. Leon Black, a co-founder of Apollo Global Management, made his debut stock sale with $172.8 million. Jamie Dimon, who leads JP Morgan Chase, recently sold $150 million in stock, making his first sale since he took on the CEO role nearly 2 decades ago. Mark Zuckerberg also let go of about $638 million in Meta shares. Even Warren Buffett, often seen as one of the best investors of all time, seems to be stepping back. Last year, his firm sold an impressive $32.8 billion in stocks. Instead of buying more shares, Berkshire Hathaway is now sitting on over $275 billion in cash after divesting over half its Apple holdings. Buffett described the market as a casino, which might reflect his skepticism. Why are these renowned investors choosing to sell their stocks? Could these billionaires know something that we don't know? It appears they might be bracing for an expected downturn in the market. In light of his dire predictions, here are steps that Rickards advises individuals to consider to safeguard their financial future. 1. Stake 10% of your portfolio in tangible gold. While the US dollar serves as a significant reserve currency globally, a decrease in its value against other currencies, from 1998 to 2008, for instance, usually leads to a surge in gold demand, driving its prices higher. During this period, gold's value nearly tripled, surpassing $1,000 an ounce in early 2008, and continued to climb, reaching over $2,000 from 2008 to 2012. Investors often seek gold during times of market anxiety, anticipating a drop in stock prices. This precious metal is viewed as a secure investment option, functioning as a refuge when markets decline. Gold's value generally remains stable, unaffected by fluctuations in market conditions. Incorporating gold into a diversified investment strategy is crucial, as its price tends to rise when the value of traditional assets like stocks and bonds decreases. To begin investing in gold or any other commodity, click the link in the description to access the platform that allows you to start your trading journey without worrying about commissions. The next step is to diversify your portfolio. Diversifying your investments is a smart way to protect yourself during uncertain times. But it's not enough to just spread your money across different assets like stocks or bonds. To truly stand out, you need to look a little deeper, especially in private markets. You see, private markets refer to investments that are not traded on public exchanges, such as stock markets. Instead, these investments are made directly in private companies or assets, which often means less regulation and potential for higher returns, but also comes with higher risks. Private markets can include things like private equity, venture capital, real estate projects, and commodities, not readily available to the public and often with more direct involvement from the investors. Imagine you want to invest in a new restaurant. The owners of the restaurant are looking for $100,000 to start their business, and they are not listed on the stock market. You decide to invest $10,000 in the restaurant directly, becoming a part owner. This investment is considered a private market investment because you are buying a piece of a private business, not buying stocks that can be easily traded on a public exchange like Apple or Google. If the restaurant becomes successful, you could potentially see a much higher return on your investment compared to traditional public stocks. Private firms typically do not disclose their financial information to the public, and without a stock traded on an exchange, assessing the company's worth can be challenging. So, how can you value a private firm before staking on it? A popular and straightforward approach to estimating valuation is to analyze and compare the valuation metrics of the private firm with those of a similar publicly traded company. For instance, imagine you want to invest in a private bakery while a public bakery of a comparable size exists. As a publicly traded entity, the public bakery's financial data and valuation metrics will be available for review. If the publicly listed bakery has a price-to-earnings (PE) ratio of 20, this indicates that investors are prepared to invest $20 for every $1 of the bakery's earnings per share (EPS). In a simplified scenario, you might find it sensible to utilize this ratio for your bakery. If your bakery generates earnings of $3 per share, you would multiply that figure by 20, leading to a share price of $60 per share. If you hold 5,000 shares, the value of your equity would approximate $300,000. Conversely, if you're not into stocks and are a business owner, a job seeker, or aiming to market your services, visit Workady.com. This platform allows you to promote your products, deals, and services at no cost by creating a free classified ad, making it a valuable resource for your marketing needs. With Workady, you can explore jobs in your niche, whether in the UK, US, or anywhere in the world. The stock market will indeed turn down one day. We don't know when. Will it be this year, next year, or in 2026? Nobody knows. As always, it's essential to approach investing with a balanced perspective. While it's wise to heed warnings and involve strategies that hedge against potential downturns, it's also vital to remain level-headed and consult with financial advisors tailored to your unique financial situation. Your awareness and preparedness could serve as your best assets in today's unpredictable economic environment. Like, share, and subscribe.